Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to customer credit policy, turnover ratios, and ROI, or return on investment. Get ready, it's time to take your chance with corporate finance. We have our information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side. We're going to have a credit policy to increase credit sales. We're going to be adjusting our credit policy in such a way that we think our customer credit policy will be increasing the credit sales by $480,000. So we're going to say $480,000 increase. In order to do that, we're going to need an investment increase in accounts receivable, inventory, and property, plant, and equipment. So we're going to need an increase in those items. We're going to estimate what those items will be: receivables, PP&E, property, plants, and equipment, and inventory, with the use of our inventory turnover ratios, which we have are 6, 4, and 2, accounts receivable turnover, inventory turnover, and PP&E, property, plant, and equipment turnover. And then all the sales are expected to be collectible. So we do think, although we're changing the credit policies, that we will be able to collect on all the sales. Collection cost percent of sales is going to be 4%, so there will be an increase in the collection costs of the 4% for our new policy to collect on the sales that we are generating here. So the production and selling costs as a percent of sale are 72%. The cost to hold inventory, the cost to hold on to the inventory that we're going to be needing, is going to cost us a percentage of sale at 4%. And then the depreciation expense for the PP&E, the property, plant, and equipment, is going to be 20%, the tax rate then 30%. So we're going to go through our calculations, including the accounts receivable, inventory, property, plant, and equipment. Those are the increases in the assets that we believe we're going to need. Remembering our accounting equation, assets equal liabilities plus equity. We think the sales are going to be going up here. We're going to do that in part by seeing an increase in the assets: accounts receivable, inventory, property, plant, and equipment. And so remember, when we finance, when we look at the assets, we got to see what's the other side that's going to be happening on our accounting equation. We got the assets equal liabilities plus equity. The assets need to be financed by either the liabilities or an increase in the equity. So we're going to figure out these three items. We're going to have the incremental income statement, which will help us to figure out the effect on basically the net income after taxes. And then we will consider our ROI, or return on investments, once we understand the increase in the assets. All right, so then first we want to figure out the accounts receivable, inventory, property, plant, and equipment with the use of our turnover ratios to figure out what those items will be. Now, once again, when we're thinking about these, we're projecting an item into the future. We're doing a future kind of projection. When thinking about a future projection, notice what we're trying to figure out are items that would basically be on the financial statement. So normally, when we analyze financial statements from an outsider perspective, or just from an analysis perspective, we are usually trying to use the financial statement about accounts to figure something else out, such as the turnover ratios here. Now we have the turnover ratios and are using them to project into the future. So you could do that by reworking your formulas here, but it might be easier for most people who have memorized their turnover ratios to use the turnover ratio and then back in algebraically to the amounts we need for accounts receivable, inventory, PP&E. So let's do that first, and then we'll kind of do it the way you would probably see it after we kind of think about the algebra. So if you see this, you're going to say, all right, accounts receivable, that's a financial statement number. Why don't I try to back into that financial statement number by using the calculation for the thing that isn't a financial statement number, a ratio, such as the accounts receivable turnover, which is given. The accounts receivable turnover is going to be the sales. So we're going to have sales, and this is for the increased sales, which is the 480. And then we have the accounts receivable. Okay, whoops, that's going to be here. Accounts receivable. And that's the unknown. So that's what we don't know. That's what we're going to figure out. I'm going to make that yellow as the unknown. What we do know is the accounts receivable turnover, because we're basing that on past data, is going to be 6. So if we back into this, we can write this out algebraically. Sales, 480,000 divided by X equals 6, which we can write out algebraically. And if we were to do the math on that, we're going to say we need the 480,000 divided by 6. And there we have it. We can double check this then by saying this equals the 480,000 divided by that 80,000. That gives us 6. So if we were to rewrite the formula as if we're trying to figure out a formula to figure accounts receivable, or just do the algebra and put it into like a formula kind of basis, we would then say, let's pick up the same sales number, which is going to be the 480. We're going to pick up the accounts receivable turnover, which we know is 6. That's the given. And then we have the accounts receivable that we're calculating here, which is going to be equal to the 480 divided by the 6. And there's our 80,000 once again. Home tab, font group, and underline. So again, we're just 2 ways to get to that same number. This is the formula that you probably have memorized. You probably don't need to memorize this formula. Just memorize the accounts receivable turnover. Same thing for the inventory. We want to know what inventory is. Inventory is a balance sheet account. Let's use the thing that's a ratio that we have memorized how to figure out a ratio. Look for the unknown. So the ratio for the account for the inventory turnover, again, take a look at our inventory, our ratio section where we go over ratios in a lot more detail, but the ratio could be a couple different ways for the receivables. Cost of goods, it could be sales divided by the cost of goods sold. It could be cost of goods sold divided by the inventory, or it could be sales divided by the inventory. We are using sales here, as has been our custom in the course. Again, you can look at that in more detail as to our rationale for that. So we have the 480,000, then we have the inventory, and that's what we don't know, so that's going to be the unknown. I'm going to make it yellow, right-click, and making that yellow. What we do know is the inventory turnover. So we know the inventory turnover, that is going to be this 4. We know that. So we need to back into the inventory. The calculation would typically be, or the formula or the algebra that you can write down, 480,000 divided by x, the unknown equals 4, that you can write down now. And if we were to do the algebra, it would be equal to the 480,000 divided by 4, which gives us the 120,000. Let's put an underline here, home tab, font group, and underline. We can then double check this by saying this is going to be equal to the 480,000 divided by the 120 gives us 4. So we double check it there. Now, if we were going to rewrite it in the format, just basically doing the algebra from top to bottom to have inventory investment on the bottom, it would simply be sales. And this is what you would probably find if you're looking if you're asking someone about this calculation. They'd probably give you this calculation, which would make you think you got to memorize a new formula, which isn't typically the case because you can kind of memorize the turnover formula. Okay, and then we have the 480,000. We're going to be picking up the turnover now, the inventory turnover, which is 4. And then we're going to have the inventory. Let's call it inventory. And this is going to be equal to the 480,000 divided by the 4, giving us that 120 once again. Let's underline the 4 by going to the Home tab, Font Group, Underline. Now we'll do the same thing for the PP&E, Property, Plant, and Equipment. Same kind of thing. PP&E is on a balance sheet account. Let's use the turnover and calculate the turnover ratio to back in to the unknown, since we are more likely to have memorized this formula. So we're going to say this will be the sales. We're going to pick up the sales again. Just pick up the sales up here. This is going to be equal to the 480. And we're going to divide this by the P. I'm just going to call it PP and E for property, plant, and equipment. And that's going to be equal to, or this is what we don't know. We don't know that one. So I'm going to make that yellow. And what we do know is the turnover, once again, the PP and E turnover, which happens to be 2. Happens to be 2. So then we can back into this number. If we were to write it out algebraically, it'd be 480,000 divided by x equals 2. If we do the algebra, it's going to be the 480,000 divided by 2 to give us the 240. Let's underline this now. Home tab, Font Group, Underline. Let's recalculate it, see if we do indeed come up with 2. Looks like it does. I can do that one even in my head, even though I'm addicted to the Excel here. 480,000 divided by 2 is by the 240,000 is 2. And if we were to rewrite it, as you might see if someone was to explain this to you, to get to the calculation of the PP&E at the bottom, just reworking the algebra, it would simply be the sales, and then you're going to be picking up the 480,000, and then you would have the PP and E turnover, which is equal to, or plus or equal to, plus is easier to hit there, 2. Let's put an underline here, Home tab, Font Group, and Underline. And that would give us the PP and E investment. PP and E. Just rolls off the tongue. This equals the 480,000 divided by the 2. And that's going to give us the 240,000. Now let's consider our incremental income statement to see what the effect on net income would be if we were to implement this change. So we could say, all right, the sales, the incremental sales that we're going to be having from this change, I'm going to put this in the outer column, and I'm going to calculate all the costs after this. So notice I may not put this in the same format as you might see an income statement with the sales minus the cost of goods sold and so on. My main goal is just to see what the bottom line effect would be on the net income. So I'm going to group all the costs or expenses kind of together as one group to see, what the change would be for this kind of calculation. So this is going to be equal to the 480,000, and then I'm just going to say costs, or I could call it expenses, colon. So then the costs that are going to be included or incurred with this, we have the collection costs. So I'll just call it collection costs, which is going to be another 4%. I'm going to put that in the inside now, in the inter column. So I'm going to pick up the sales times 4%. So we have costs there of 19.2. We're predicting the production and selling costs. So notice we're kind of grouping production and selling together because we think we can group that into a percentage here. So we're going to say that this equals the 480 times the 72%. And then we have the inventory holding cost, the cost of us holding on to the inventory that we're going to need to do this. We think that's going to be the 4% of the inventory. Now, we figured out the inventory up top to be the 120,000 times. We're going to be picking up then the 4%. The 4% of that is going to be 480. And then we have the depreciation cost, expense or cost, which is going to be equal to the cost of the PP&E, the depreciable assets, the 240,000 times the 20% is the amount we're going to depreciate. And so there we have that. We're going to go to the Home tab, Font Group, and Underline, and that's going to give us our costs or expenses. Now also note that this depreciation cost, of course, when we're thinking about property, plant, and equipment, if we purchase property, plant, and equipment, it's going to have a longer term effect. So we might want to consider, the financing of the property, plant, and equipment and the time value of money with regards to property, plant, and equipment, the return on the investment itself. If we were to purchase a significant amount of property, plant, and equipment, here we're considering the expense related to it to get to the bottom line income statement number or effect. So we're going to say this will be equal to the sum of adding these items up. That's going to be the 417,600. Let's indent these. I'm going to select these items, go to the Home tab, Alignment, increase the indenting. Select this item, Home tab, Alignment, increase the indenting. And then we're going to be having we're going to calculate the bottom component of the income statement. We have income before taxes, which we have to calculate in order to then calculate the taxes. So that's going to be equal to the sales minus these costs that we're going to incur from this change. Put an underline here, Home tab, Font Group, Underline. Then we'll calculate the taxes. So taxes, which we believe are 30%. So we're going to take that 62.4 times the 30% for the taxes. Underline this item, Home tab, Font Group, Underline. And that'll give us finally the income after taxes, which is going to be equal to the 62.4 minus the 18,720. And we've got the 43,680. So we have a positive effect, the 43,680 for the change that we're considering here. Let's look at our return on investment. Now we can consider these asset increases as kind of like an investment, right? We have an increase in the assets here, accounts receivable, inventory, property, plant, and equipment, and we can measure that against the net income that's going to reflect on it and predict a return on investment, which we might be able to use, and oftentimes we'll have kind of a benchmark of ROI or a return on investments that's going to help us to determine whether or not a change is worth taking or not, because there's risk involved with any kind of change that we implement as well. Obviously, these numbers are projections, so we might say that, hey, if we're going to make a change, I mean, we might basically think that, we're going to stick with the default unless there's a significance over a certain amount, which would warrant the change, right? So we might say if the ROI is 8 or above, then we think it might warrant the change or something like that. So oftentimes we'll set a baseline and then we can do a calculation and say, okay, well, is this worthwhile to do? So if we think about that, the ROI that what we got then is going to be this 43,680, and then we can think about the investment, which is basically going to be the increase in the assets, right? The increase in the assets as compared to, or the net income as compared to the increase in the assets. So we had an increase in the accounts receivable. I'm going to put that in the inner column. That's going to be for the 80,000. We had an increase in inventory, which is an asset, and that's going to be for the 120,000. We had an increase in the PP&E, the property, plant, and equipment, PP&E, and that is going to be for the 240,000. So we have the investment in assets, increase in assets. I'm going to put that in the outer column then, equals the sum of, hold on a second, I need a bracket there. Bracket, trusty sum formula, the 80 down to the 240, and enter. Let's put an underline under the 240, home tab, font group, and underline. And then we're going to get the return on investment, which is going to be equal to the 43,680 divided by the 440. Let's make that a percentifying that number, home tab, numbers group, percentifying it. We could increase a few decimal if we so choose. We're at the 9.93. I'm going to then underline here, home tab, font group, and underline. So if we work this out, we're going to say, okay, we've kind of figured this out. We're thinking that it could result in income after taxes. If I look at the ROI, we're at the 9.93. Now, we might have a policy saying, hey, it needs to be over a certain threshold, and if it was some threshold, if we have a threshold of the ROI or ROI needs to be over like 8, then it would be good. If we have a threshold of like 12 or something like that, this would be under that threshold. It might be something that we would say, nah, we're not going to go there because it's below what we think the justifiable rate of return needs to be in order for us to take the time to implement it, in order for us to move away from the default of the norm that we have right now and take the risk of the new change that is being considered.